This is the final lesson of this financial modeling course. So we've now pretty much completed building out the cash flow profile, and we've also improved the formatting of the spreadsheet. But what we haven't established yet is we haven't established how much we can actually pay for the asset. And what we're doing in this lesson is we're learning how to use the Gold-Seek formula so that we can then back solve the purchase price so that Thanos can achieve its target returns. But the question now is how much can they actually pay, right? And we can establish this by doing this via trial and error. So they can pay 90 million. What happens if they pay, let's say, 80 million? So now you can see, okay, our returns have gone up. They're 13.2%. Now let's say what happens if we pay 70 million, or here 70, not 700 million, 70 million. You can see the returns have gone now up. Or we can be a little bit more quick and we can go to Goal-Seek, and we can do this by going to data, what if analysis, Goal-Seek. We select the cell that we want to Goal-Seek, which in case is the target return. So this one here, data, what if analysis, Goal-Seek, cell E65, to value 20%, right? By changing the purchase price. And now we can Goal-Seek the IRR by changing the purchase price. So we're setting the IRR to 20%, so that's 0.2 by changing the purchase price. And this then gives us the purchase price that we can afford to pay, or that Thanos can afford to pay, to achieve a 20% IRR. So let's click on OK. And there you go. So now we can see the IRR is exactly 20% if Thanos pays 67.399 million euros for this asset. So this is the purchase price that Thanos can pay to deliver a 20% IRR, which is materially lower than the ask by the vendors. The vendors asking for 90 million, we can afford to, or Thanos can afford to pay only 67,399 million. So what would now happen in practice is they probably would sit at a table, discuss how much they can pay. Thanos would say, well, this is what we can pay. And the vendor will either say, well, bugger off and I'm not going to work with you. Or maybe, you know, he's willing to negotiate some sort of agreement, and maybe he's willing to lower his ask. Always depends on the situation. But that's basically the end of this case study. Just to recap, we did this quite quickly. It was a very simple cash flow model on one page. It was very simple because that was the ask. It was a simple cash flow model with one single lease on a long-term lease, so no need to have things more complicated. We started off by modeling, or by including the assumptions, then we modeled the asset cash flows. After that, we modeled the unlevered cash flows, then the levered cash flows, and then finally we improved the formatting and the look and feel of this financial model, and we establish how much Thanos can pay. There's still many things that we haven't done yet. So for example, we still don't know how to model multiple leases, and we don't know how to model multiple short-term leases, and what happens when those short-term leases expire. We don't know yet how to model a CapEx program, or we don't know how to model taxes. We also don't know what sort of promote mechanisms and incentive mechanisms are. So there's a lot that we haven't learned yet, but this is a really good beginning. And if you want to learn more, there are several courses on my website that you can sign up for, and they will teach you essentially everything that you need to learn to secure a job at a prestigious investment firm and to really sort of take your financial modeling to the next level. But this is a really good beginning. So now you know the basics of real estate financial modeling.